So good afternoon. Welcome to today's Wednesday webinar. I am your host, stockdarts, and this is the first Wednesday webinar of 2019. Let's see how this year goes. We're going to do the usual. I'm going to go ahead and cover the four major markets. We're going to look at the S&P 500. We're going to look at the Dow Jones, the NASDAQ Composite, and the Russell 2000. Once we're done with that, we will take a look at the U.S. dollar, see how it's faring, see how gold, silver, and oil are doing. And once we're done with that, we'll move on to the chart requests. Denise, Ray, Blackhawk, if you guys have any charts that you're looking at, any questions regarding patterns you're looking at, especially as we start the year, go ahead and put them in there, and we should have some time for some discussion today. So if you are interested, for those of you that are watching on YouTube, you can follow myself or Frank. Frank's not in right now. He's actually on vacation for the holidays, but you can follow either one of us at StockDarts or StockGuy22. You can find us on YouTube under the same names, and you can also find extra content from me at patreon.com/StockDarts if you are interested in more of my style of trades or my style of technical analysis on the markets. Other than that, let's go ahead and get started and take a look at the S&P 500. And you can see we're starting off the year on decent footing. We're actually down slightly, but we have a nice green candle. We opened up at lows and have been rallying pretty much for the majority of the day so far. If we go ahead and take a look at a 5-minute chart, you can see that we gapped a little bit below the close on Monday and have sort of run up towards highs and then have recently pulled back a bit. But overall, the markets are at least stable, and it's going to be interesting to see what happens now, because a lot of times when you have the start of a new year or a turning point in any kind of major date, sometimes it changes the character or nature of the market. I don't know that that's going to be the case so far with the start of 2019, but you never know. Sometimes that happens. After all, these markets are very heavily influenced by human emotions and by human thoughts, and a lot of times we look at this like the start of the new year, and sometimes it changes character. That's not really what I'm expecting, but it is something I'm paying attention to, and I think a big part of that will be how we end up closing over the next few days and finish off this week and see what goes from there. For those of you that were here last week, we had not a lot going on as far as what to do with the market, right? Because we were oversold. We had just dropped quite a few days in a row, and we were due for a bounce, but there weren't any really good prospects or trade setups to the long side. And we did get that bounce, and I think that there's a potential for a little bit more of a bounce, but overall, I'm still not excited about playing this market right now to the long side. I still think that we are in a very troublesome market, and I suspect that 2019 is going to be a difficult year for a lot of traders. Hopefully, as we go through these Wednesday webinars, we'll be able to sort of team up and come up with some good trade ideas or good analysis of this market and help you guys navigate some of the muddy waters that I'm anticipating for this year. And we'll be able to at least avoid some of the pitfalls that trap a lot of traders when the market shifts from what we've seen over the last couple of years to what we're getting now, right? So if we go ahead and take a look at the weekly chart, and you can see the market has been in a really nice run for the last couple of years. And then 2018, despite the fact that it ended up being a down year, had a really nice predictable part of it. The meat of the year had a nice rally. And overall, it wasn't until the very end that we got an ugly market. But overall, it was not that difficult of an environment to trade for a good portion of the year. We had some difficulty in the beginning. We had a lot of difficulty at the end. But for the most part, it was a pretty smooth, trendy market. And that's probably not going to be the case this year unless the trend is down. Looking at it, you take a look at where we spent the majority of the year, you can see that we have a pretty wide range, right? And that was the anticipation as we approached the beginning of last year. We were looking at the possibility of a broad corrective range, right? And these broad corrective ranges a lot of times take place over more than 1 year. They take place over a couple years. You take a look at what happened from 2015 to 2017, and that was 2 years of chop for the most part before we entered a nice strong rally at the very end of 2016 and beginning of 2017. And so the question becomes, have we already done the broad range consolidation, or are we still in the midst of attempting to hash out that range? clearly we're below the range, right? So that's a negative. And that was really the big change in character that sort of spurred me to warn you guys to be a lot more defensive as we were closing out last year, is this idea that we are not in a good place here. And while I suspect that we try to come back into this range, I think ultimately we probably fail and head lower. And anytime you're below a critical range like this, there's a lot more potential for downside surprise than surprises to the upside. And that's why right now it's important to play defense, and it's important to make sure that you protect your capital and don't try to get too aggressive in calling a bottom. The same as traders that have been trying to call a top since really the beginning and middle of 2015, right? There's a lot of attempts at calling a top here, and some of them worked for short-term trades, but then once we started rolling into the second half of 2016 and the beginning of 2017, traders started saying, no, this market's not going to keep going up. This is impossible. We're going to go down. And I know a lot of traders that just kept shorting this, trying to call the top, right? And as a trader, it's not your job to try to come up with this perfect call of what the market's going to do, right? You're not supposed to try to predict these tops. You're supposed to react to what the market does and just follow it along as it does what it is want to do, right? And at this point, it's not in our best interest to try to call the bottom and to try to say, yep, we're done. I was the first one to call the bottom. We're ready to go back up. That's not our job. Our job is to sort of figure out what the next possible scenario or two or three scenarios are and react to them as they occur, right? So right now, we look at a couple scenarios. Could this be a bottom, and could we come back into the range from 2018? Yeah, it's definitely a possibility. However, could it be a possibility that this is just a bit of a dead cat bounce and we're going to come up and retest last year's range and then roll right back over? Yes, that also is a very strong possibility, right? So it's not our job to say conclusively this is what's going to happen. It's our job to say, well, these are two types of scenarios that could occur. What are we going to do when either one occurs, right? And that's what you do as a good trader, is you outline a couple different scenarios and you put a plan in place as to what you're going to do when that occurs, right? And so I think the more likely scenario right now is the same one I mentioned last week, which is we bounce up towards resistance. And once we get there, we keep our eye out. And if we see selling start to really increase and we start to see some reversal patterns up here around this 254 area in the S&P 500, then we probably have a good shot at getting some short trades as we come right back down and start retesting some of these new lows that we printed. As long as we stay below this range, we have to assume that the market at the moment is still looking to go lower and still looking to figure out where buyers are in the overall markets, right? So that's where we stand. We can go ahead and make a couple modifications here. We can get rid of this white line here. This was the opening range from last year. At this point, that's not something we need to concern ourselves with too much. We got to start looking at what's going to happen this year. It's a little early for me to start marking this year's opening range, which at the moment is 245 to about 250. But that's going to be a price point that will be relevant at some point this year as we start to move forward. But for now, the levels we really need to concern ourselves with is 254 to 255, which is going to be critical resistance, and this is the key area we need to get above. As long as we stay below 255, we have to assume the market wants to go down. Despite what we're seeing right now, the strength that we've seen the last few days, if we do not eclipse this point, then we have to assume sooner or later we're going to roll right back over and start testing the lows, right? So if we can get above 255, that's a great starting sign, right? Or that's a great starting point to start the year and to make sure that we start making some bullish strides towards reclaiming a lot of this lost ground. However, even if we get past that, we've got the 20-period moving average moving down very quickly. We've got the 50 swooping down, and we've got the 200-period moving average also moving down. And we have this other area around 263, which is ultimately where we really rolled over at the end of the year and started to really explore new lows, right? So there's a lot of overhead resistance. There's a lot of pit stops. And at the moment, I'm not, as I mentioned before, not very inclined to try to trade this to the long side. For me to want to get behind the market and start looking at some good long trades, we're going to have to see more. I think ideally what I'd want to see is for us to continue making our way up to 255 and then build up a nice pattern here, a nice flag or pennant, which could give us good risk reward and a good sense of timing as we try to break past that. If we continue to just kind of march higher, right? If we just continue to do like this, then I'm not going to go ahead and get involved to the long side, because then we're going to be overextended to the long side into critical resistance areas, right? So that's not something I'm keen on as far as trading to the long side. The other idea, of course, is trading to the short side, which would be if we come up here to 255 and then we struggle in this area and eventually roll right back over, right? So let's say we respect the trend line all the way back up to 255. And then as we try to break past that, we fail, we come down, that becomes a good short trade and a good way to look at trading to the downside. Now, again, this advice doesn't necessarily mean that's what I'm going to do as far as trading the S&P 500. Oftentimes when we do this, I don't actually trade SPY. I just try to analyze what environment we're in so I can look for other types of trades in other equities that would match these patterns that are going to give me better returns than maybe what I'd get on the S&P 500. But that's what I'm looking at, and I think that's the key level. Right now, 255 is really a critical level, and that's the spot that we need to look at as far as whether we can continue to build on this and start off the new year on a positive note, or whether we are going to continue with the selling that started in October and really hasn't conclusively come to an end yet. Right now, we do have some signs of capitulation. This is a positive development, at least as far as what we can expect. For those that maybe don't know what capitulation is or how that works, capitulation is sort of the exhaustion of a move, typically to the downside. When you have a move that started in October, right, and you have these big moves, and eventually it accelerates to the downside, and you get this huge volume surge, right? That's a potential sign that we've exhausted all the selling pressure, right, and that the buyers are finally ready to come in. Now, what often happens in these sorts of scenarios is you get a big push on heavy volume, then you get a nice bounce, and then eventually you get a return to test that level again, but on less volume, showing that there's a lot less emotions involved on the second retest. And if that second retest ends up being a positive sign, and you get some signs of support, you get some candles, some nice hammer candles or some nice bullish engulfing candles, and it shows that buyers are willing to step in and defend that price a second time, ultimately you get to move back up, and that's how you end up forming a potential double bottom and starting to move higher, right? So that's the pattern that we're looking for, and I think that would be the most likely bullish scenario that I could get behind. Would be sort of a double bottom and a sort of a capitulation bottom off of volume that shows that we have sort of tested this area twice and want to make our way higher. Now, even in that scenario, we still have a lot of overhead resistance we'd have to get past, but the risk reward might be worth it depending on how that pattern plays out. Now, again, that's speculation as far as how candle patterns might play out over the course of the next month and a half. So a long time to go before something like that plays out. But that is something we can keep our eye out for and see how it develops over the course of the next few weeks as we meet each Wednesday, right? Now, as far as the short play goes, again, if we close today strong and we close tomorrow strong and we end up somewhere around 254 to 255, and then we either try to break past it and fail, or we just sort of stall out for the next few days and then roll over, then I think we have a possibility of looking at some short plays. Now, again, do I want to short the S&P 500? Probably not, but I'll build a watch list of names that I want to short. I will be certainly looking to add one of those names to the Patreon.com page over the next couple of days so that we have something to add to our watch list as we start next week and as we start to move forward into the new year. Now, that's a picture of the S&P 500. Again, I don't think we need to really pay attention to any key levels above 263. I think to get above that level would be a major victory, but something that's a long way coming. I think, again, the levels we can watch are 255, and then 263 is a serious level that we probably wouldn't pass even if we got past 255. And then obviously to the downside, if we roll over here, then we need to see 234 hold as support to sort of lend credence to this idea of a possible capitulation bottom in the works. Okay, now if we move on to the NASDAQ and take a look at the Qs, we can see sort of a similar pattern playing out, right? We've got a nice bounce coming. Now we are at resistance already on the Qs, right? You take a look at what's going on here, and you can see that we had a nice channel, pretty well defined move down on the Qs through most of the end of 2018, and then we accelerated to the downside again on heavy volume, and at the moment are trying to at least get back into this channel, right? And trying to show that we are forming a bottom. Now, this is actually a spot here where typically if you're trading an equity, you're already looking for a short here, right? If we can't get back into that channel and we roll right back over, this could be a short play. Now, I think this is a little early to be looking at a short just based off of today's action, but who knows? We'll see how we close out today and how we open and trade tomorrow. You can see the 20-pair moving average. Again, that's the brown one, swooping down very quickly to meet price. You've got the 50, again, angling down pretty quickly. And even the 200 is starting to roll over, right? So overall, more signs of a market that's really struggling and changing in character from what we've seen over the last several years. It's been a long time since we've really had to discuss this idea of a market that's ripe with short opportunities and bearish in nature, with overall more selling than buying. It's been a really long time since we had to really discuss anything like that. We go back again to the weekly chart on the Qs, and you take a look at it. Even back here, the market wasn't really in the situation that we're in now. Again, look at the moving averages, right? Look at how much they're rolling over now compared to the crossover we had in 2015. And again, 2015 did have some really ugly selling action, but I don't think it really compares to what we're seeing right now, with the fact that we've actually lost key technical support levels across the board on all the major indices. In 2015, we had the one really big drop, but once we kind of recovered from that, while we did come back and test lows, we never really had a reversal where we started printing new lower lows and lower highs, right? For the most part, we were able to base out and start making our way upwards again, and we have still really not had a conclusive reversal here where we could say that we have defined a new range. We're still testing lower, and as long as we test lower, we have to assume that this is a big change in market character, as opposed to what we've seen really for the last 10 years or so. And because of that, I cannot stress again how important it is for us to trade very cautiously at the moment and to make sure that we're being defensive and protecting our capital. The market always gives good opportunities when they are least expected. There will be good trading opportunities this year. They may not be to the long side. They may not even be to the short side. They might be sideways trades where we trade a range and play covered calls. It might be short trades. We don't know yet exactly what's going to play out, but the market will give us trading opportunities if we are astute enough to analyze what the market's doing and to find suitable trades that match what the market's doing. And again, that's really the key here, is you don't want to make this broad statement and this proclamation that the market's going to do this and then trade that. You want to be a little bit more fluid about what you're thinking and interpret what the market's action is and try to react to that, right? And so again, that's what we're doing right now, and that's why we are really trying to keep an open eye as to how that we're going to start 2019. And again, I think the more likely scenarios are all bearish, but we want to keep an open mind to the possibility that maybe, just maybe, we found a good bottom here and are ready to try to reclaim some of this lost range. Now again, if we step back, we can get rid of, again, this white line here was the opening range from last year. We can get rid of that, right? What we could do now is mark off last year's total range, right? And if you include this lower wick down here, we're technically on the Qs actually still within the range of last year's broad corrective range, right? So we had a temporary drop below that, but we've kind of come back in. Now, we have a very important level here, right? And I think ultimately that might be the key level we really need to get back above, is this 156 area. That was the meat of the price action. But technically speaking, we are inside of last year's range based off of some of these lower wicks, right? Even if we take a look at some of this price action down here where we really bottomed out around 154 last year, like around March and April, we're kind of right back above that area, right? So the Qs are being a little bit more constructive than maybe what we're seeing on the S&P 500, despite the fact that we still have to recover through some pretty critical trend lines to get back into an area where we could be a little bit more comfortable about trading to the long side, right? And if we take a look, and we'll do this during the chart request section, if we take a look at some of these tech names like Amazon, Google, Facebook, you'll see that a lot of them, they still have a lot of work to do, right? A lot of the FANG stocks are not really in a great place right now. They have staved off their drops and have started to try to form bottoms, but they still have work to do, and I think that's reflected in what we're seeing out of the Qs. But overall, at least with the Qs, there is a somewhat positive sign in that we are not underneath the range as we were with the S&P 500, right? And again, that's always the worst case. You don't want to lose a base and start trading underneath it. When that happens, there's always more chances that you continue to drop down and continue to explore lower in that scenario. So that's at least a positive with the Qs. So the levels we need to watch are pretty close by, right? We want to watch this descending trend line here. I'm going to go ahead and color it red for now. Although I don't think that this trend line is going to be a major impact on what we're doing. It is something we want to get back above. The key area really is 150, which is the lows from last year. Well, the lows from the beginning of last year. Obviously, the lows of last year are way down here, 143. But that's really the area we want to stay above, right? Is this 150. And really 156. That's the other key level, right? So we're going to watch 156 and we're going to watch 150. And that's the area we really want to be concerned with to see if we can stay kind of in last year's range. Now, I know we can, I could be, someone could be pedantic and say, well, really, last year's range is this, right? And ultimately, that might bear fruit, right? That might be the situation we need to watch is really last year's lows do technically count as last year's range, right? So with the S&P 500, technically speaking, when I'm analyzing this range, I'm talking about the lows of last year, the earlier part, but technically, really, right? You could say that last year's range was this, but I'm not really concerned with last year's range as much as with the base that we formed, right? And I think the base that we formed was really with 254 to 255 as the bottom. And I think, again, with the Qs, the base that was formed last year really was probably something like this, right? And if that's the case, then I think that we are technically right at the edge of trying to hold into that base, right? Now, some could say that the wick down here counts as part of that base. And I could see an argument for that, but I would say something like this is probably more likely what I'd want to consider as far as the base is concerned. Good morning, Sam. Glad to see you have some time to stop by. I hope you have a happy and successful New Year as well. Good to see you in here. Good to see a lot of you guys in here. I didn't expect a big turnout considering it was, I know it's not really a holiday anymore, but just the day after New Year's. And I expected people to be taking some time off. So good to see you, Sam. Hope you are working hard, but not getting worked too hard. And we have some time to see you in the new year. All right, so that is my analysis of the Qs. Again, very similar to the S&P 500 in that we are bumping our heads up into some key levels here, and we'll see how we can react to that. And again, I think the key level is really closer to 156, but we'll see what happens in this little zone here. This is a pretty big area, and we want to see whether there will be some buying to start the year or whether we're just going to resume what we've seen for the last couple of months now. Now, here's the Dow Jones. The Dow Jones, a lot like the S&P 500, is clearly, without doubt, below the base that we formed last year, right? Even if we include all the wicks, we are 100% below the range that we spent most of the year in, and are bumping our heads into resistance, right? And again, you can sort of interpret this in a couple ways, right? You can include the wicks, or you can say we want just the meat of the price action. I tend to prefer the meat of the price action. I think that this level around 235 is more important than just testing and probing these temporary wicks that developed over the course of 2 strong days. So for me, I think 235 is a more important level to get above. But you can see that even these wicks from way back in March and April have had an impact on the price action of the Dow Jones in the last few days, right? You can see we're struggling right here around 233 and have not been able to clear that area, right? So a lot like the S&P 500, we are below our previous base, which means more likely than not, there's more chances of being surprised to the downside. There's more chances of us bumping our heads against this level and rolling right back over and moving down to lows, right? So it looks positive, right? 1, 2, 3, 4 out of the last 5 days have been nice big green candles, and we've made a lot of progress from 218 all the way back to 230, right? So that's positive. That's not a negative. But as I said last week, even if we do run up to these levels, really the critical point now is what we do at 235. Ultimately, until we have a clear reversal of this price action that emerged throughout October, November, and December, we have to assume that the trend is still down now. And until we see a conclusive change in direction, we should be looking more often at playing this to the downside, right? So at the moment, I don't think that we are ready for that. I think that we still need to come up and test these key levels on most of these indices. But I'm expecting a lot of selling pressure to step in here, and I'm expecting us to find some reversal patterns here. So my mindset right now is to start scanning and start looking for shorts, and I'm more likely than not, the first trade of the new year is going to be a short trade, as far as swing trading is concerned. And so that's really what I'm anticipating. Now again, I'm keeping an open mind to this, and if we develop a pattern here, a nice consolidation range, and we build up a nice bit of buying pressure before we break out, maybe it ends up being a buying play, right? But for now, I'm anticipating us to find some selling pressure at 235, and more likely than not, I will be looking at a short play. Now, again, what oftentimes happens in these scenarios is you get a move back to that level, and then it rolls over, but it doesn't go all the way to lows. So if I do short, will I be looking for a move to lows? Not necessarily. I will probably take partial profits well before that, but I will leave a piece of the trade open looking for the lows if there is the possibility of that, right? So ultimately, I think it's a little early to say what's going to happen, but judging by the price action, again, we can get rid of this. We don't need to look at last year's range anymore, but you can see we're a long way from where we opened last year on the Dow Jones. And we'll see whether we can get back above 235. This is going to be a critical level. Again, I think the levels we need to watch ultimately are very similar to the S&P 500. We've got this level around 243, which I really don't think we get past, even if we have a bullish move over the next couple of weeks. We have 235, which is kind of the line in the sand. And then, of course, we have our lows around 218, which I think probably hold, even if we do roll over here. I think that these levels probably hold, at least in the near term, until we start to get more news that can maybe move us in one direction or the other. So I anticipate from here to next Wednesday, I think that we probably trade somewhere between 235 and probably about 225 to 222, somewhere in that range. And it's probably similar scenarios across the board, where we bump up into resistance, we probably try to push past it and fail, and then start to head lower. Do we head to new lows from here to next Wednesday? Probably not, but there is the possibility. I think there's more possibility that we head to new lows than we break past this 243 area. And then finally, let's take a look at the small caps. And the small caps are way, way below all the key levels, right? So again, we can close, we can get rid of this. We don't need to see the range from last year as far as the opening range goes, but we can look at our base from last year. I'd say it's something like that, right? And you can see we tried our best in October, November to hold at that level and ultimately failed. And for those of you that were trading or watching us and visiting these Wednesday webinars, you'll know that this was one of the key warning signals for us as far as trying to figure out if we were going to get more downside in the markets, was what IWM and the small caps were going to do at this 145 level. Once we lost that level, it was pretty clear that the market wanted a lot more downside. And so this was one of the key warning signals that we were looking at and should have kept, hopefully, most of you guys on the sidelines during the big drop that we had in December. Because, again, it was told to us, right? The market told us, hey, look, you're going lower, or I'm going lower. And that's exactly what IWM did, and was basically the leading indicator to the downside for the markets, right? And so it dropped significantly. And you can see we've had a nice bounce over the last 4 or 5 days, but we're nowhere near this 145 level, right? So we lost that base decisively on the small caps. Clearly, traders are still not willing to accept risk. I think that's an obvious one, right? Like when we're analyzing this towards the highs and we start to look at to see whether traders are willing to accept risk, sometimes it's harder to tell, right? And I think that's one of the reasons that it's good to look at all four of these indices and to try to figure out whether there's strength in IWM or the Dow Jones or the S&P 500. Because ultimately, depending on which one is doing good and bad, it tells us a lot about the attitudes of traders. Now, at the moment, I don't think we need to really delve too deep into that because we know the attitude of traders, right? Traders are terrified of the market right now, right? So clearly they're not going to be taking risk, and clearly IWM is going to be performing the worst of the four indices, right? And I think that's pretty clear when you're looking at it from a relative basis. Compare where we are on IWM compared to the other three indices we just watched, and you can see we've got a long way to go before it kind of comes up and reclaims this base. And I think that's going to be the case for a while now, is IWM should lead to the downside and should give us the warning signal that we are heading lower if it loses its lows, right? So where can we expect this to go? I don't think that we can really say what the resistance level is going to be. It's probably just going to be the 20-pair moving average. We almost certainly don't get back to 145. If the market stalls out and rolls over, IWM is going to roll over well before 145. It's probably going to come up to about 135, 136, meet up with its 20-pair moving average, and then if the market rolls over, IWM won't get too much past that, right? And then it'll head right back down to lows, and then this will be the tell as to whether the market is ready to double bottom or whether it needs to start exploring even lower. And I think that's the key right now, right? With IWM is we're not concerned too much with the upside. We want to see how it behaves relative to the other three indices and see if traders are willing to start looking to trade more than just the big NASDAQ names or some safer Dow Jones names, right? And again, smart traders right now are being defensive, which means they're probably staying away from a lot of small caps and they're looking at some of the safer names, maybe that produce dividends or have a much safer range as far as range of possibilities as far as where they could end up in the bearish market, right? And that's what we need to do right now. Again, is really not get too over aggressive, not try to be the first one in to call the bottom. We want to be safe. We want to take high probability chances here, and preserve our capital for easier markets. If we do continue to the downside, that actually is, while it's a difficult market for a lot of traders, especially those that have to hold trades, for swing traders, a down market is actually pretty easy to trade. Because again, it oftentimes means that most stocks are moving in the same direction, and it's really more a matter of psychologically being okay with taking trades to the short side and sort of ignoring this sort of hardwired attitude that we have to look at trades to the long side. It seems like it's human nature when you look at a chart to immediately look at where it can go up, not where it can go down, right? And so that's one of the keys and big adjustments that a trader has to make is flipping this around and looking at it from the other direction. But if we do get continued selling pressure like what we saw throughout last year, that actually is not a difficult trade environment if you can be open-minded enough to take trades in the right direction. And so that's going to be one of the things we really want to watch and anticipate this year is whether we do continue to sell off. Now, again, we're very, very oversold. Even with the bounce that we just had, overall, you can see we've gone down quite a bit in a very short amount of time. So there has to be some reaction to the upside. And I think that's what we're seeing now. And there is potential for even further bounces before we can really hash this out. But ultimately, once we sort of stabilize, then we have to figure out whether there's going to be more selling or whether we base out and start forming a new base, whether it's above the previous one or whether it's we make our way back into that, right? So as a whole, I'll go back to the S&P 500, and we're going to look at a weekly chart, right? As a whole right now, clearly we're not in a great spot. But that being said, we've moved quite a significant amount in a pretty short amount of time, right? So The question right now is, do we spend the new year forming a new base and then ultimately either rolling over or coming back up? Do we make our way back into the previous base, or do we continue sort of crashing and correcting, right? I mean, that's basically three scenarios. It's not rocket science. That's really the only thing that can happen is one of these three scenarios, right? And it's up to us to figure out which one is the most likely one and go from there. I think from here to next Wednesday or the next couple of Wednesdays, the most likely scenario is that we still try to make our way back up into that range. And then from there, we'll have a better idea of whether we are going to do this or this. And I think this is, at the moment, the least likely scenario, but it is a possibility, right? And for me right now, I think the key is, obviously, we watch this area around 255, and if we don't get above that, then we just have to flip to short and flip to that style of trade until we see a bottom form. And again, I don't think that we can conclusively say we found a bottom. We did find a nice bounce, but is this a bottom? Not yet. I think we need more price action and more definition on this before we can say that we've conclusively found a bottom at the start of the new year. I think that this is just a reactionary bounce, and there's still plenty of proof that needs to be put before we can say that the buyers have kind of sort of regained control in this market. Okay. All right, so that is the four major markets. Again, not quite as doom and gloom as last week, but I think still pretty negative. I don't want to, a lot of times traders swing back and forth their mentality with the most recent green candles or red candles, right? And I know a lot of traders are probably itching to buy because they've seen these nice green candles, right? And I don't think that that's really the right idea right now. Could this continue to bounce? Sure. Would I be upset if it does? That I missed out on a buy? No, not at all. Because again, right now, discipline is the name of the game. You want to be cautious and defensive until we get a better scenario. If this is ultimately a bottom in the market, we will get a better sign and better trading opportunities once we start to navigate into our previous ranges and establish new bases that we can use as support zones to get better risk reward. And I think that's really where we stand right now, right? We want to find the best risk reward. And I think at the moment, the best risk reward will be on a short trade, but don't just short because it hits 255. We need to see selling come in and overtake the buyers that just sort of stepped in over the last few days. Okay? All right, let's take a look at the US dollar. We'll look at gold, silver, and oil, and then we will move on to the chart requests. Those of you that are in here, if you have a chart request, I'd love to see what you're looking at. And if there are any possible patterns that are sort of mimicking the markets, and maybe we can find some trades earlier than the next couple of days. So here's UUP. Now, what's very interesting about the US dollar index is you can see we've started to lose ground on the index, right? You can see this trend line. I think that's still not really that negative, right? Because we're still just sort of probably slowing down that trend and forming a new base, right, above this previous base. But this isn't really mimicked in some of the patterns or some of the currency crosses we like to look at, right? We take a look at the euro. And the euro is actually struggling versus the US dollar, right? So again, this is inverse, right? So up is good for the euro and bad for the US dollar. Down is good for the US dollar. The US dollar, and this is actually very interesting because we've had 3 false moves already. We had a false move to the downside, a false move to the upside. We came back and retested another false move to the upside, and now we're coming back down. Sooner or later, one of these moves is going to have to stick, right? So this looks like the dollar is picking up steam versus the euro. And if it continues to hold and break this ascending trend line, then I think that this is positive for the US dollar. It means the dollar is ready to bounce, and is negative for the euro. It means the euro is going to lose a pretty critical area and drop even further. Now, again, a lot depends on how this candle closes out, but at the moment, that's what it looks like. Now, that, again, it's not really reflected in what we're seeing out of the UUP index, right? I mean, we do have a nice little bounce today, but overall, it's still sort of trying to stabilize. It's not really ready to make a move. But if we look at the US dollar versus the Canadian, it's actually in the process of sort of rolling over. And a lot of this is a function of its sort of inverse correlation with oil, and oil is starting to bounce. But again, we're looking at the US dollar start to stall out after it already had a big move, right? So this is a little bit more indicative of what we're seeing out of the UUP index, just slightly lagging behind it. So maybe not correcting yet. Well, we've seen it correct a bit in the UUP index. If we look at it versus the yen, we can see that this actually is very similar to what we're seeing in UUP, in that the US dollar has lost a lot of ground. Now, that being said, it's forming a nice hammer today, and looks like it's ready for a reactionary bounce to the upside. So overall, if we take a look at what we're seeing out of the US dollar, I would say that it's getting ready to move versus the euro, right? It's getting ready to move upwards versus the yen. However, it looks like it's about to roll over versus the Canadian dollar, right? So that being said, I would say overall the US dollar as an aggregate is probably due for a bit of a bounce. And if that's the case, now might be the time to take some profits on gold or silver trades. Now, those of you that are regulars for the Wednesday webinar know that we've been long gold and gold miners for the last 2 or 3 months, right? Since November, since it started to break out of this channel. So this was one way that we've been able to navigate through what was an ugly December in a positive manner, was by trading something like gold that was trading basically inversely correlated to the markets, right? Judging by what we're seeing out of the US dollar, this is a good time to scale out or to just close out the trade altogether. We've had a real strong move. It's starting to get a little overbought. You can see forming a shooting star today. And so if anyone here actually traded, the gold trader followed me on some of these GLD trades or GDX trades, this is not a bad spot to take some profits. Now, a lot of the gold miners didn't move up quite as strong as GLD. And if the market continues to bounce, they might move with the market. So you might want to trail stops on gold miners rather than just close out. But overall, we should be looking right now at taking profits on GLD and SLV names. Now, SLV, again, we didn't really trade SLV because there was a lot more upside on GLD and gold names than silver. And SLV and silver actually might have a little bit more upside to about 1480. But overall, I'd say this is the point where you want to start looking at scaling out of these trades and waiting for the next buy cycle, which not sure when it'll come. But for now, we want to see them sort of consolidate and set up new patterns. Now, that being said, we have seen some new impetus and some new moves on oil, right? You can see oil, nice move today. Nice potential bottom here at 42, which was a point that we mentioned last week as a possible area. Again, that's a major level. If we go back and we go to, say, a monthly chart, not even weekly. Actually, we'll go to the weekly. We don't need to. The monthly is pretty far back. But even the monthly, you can see that 40 is a very critical level from quite a bit of time. But if we look at the weekly, you can see that we spent a good portion of the last few years trading between 40 and about 55, right? We came back and tagged 40 last week. And at the moment, that looks to have been a good level of support, right? So some of those oil names that we looked at last week might be doing a little bit better. And again, this is probably part of the drag on the U.S.-Canadian cross. And if this continues to come up, then the U.S. dollar might lose a little bit of value versus the Canadian. And that might be a decent Forex trade to take for those of you that are into that. All right, so that's oil, gold, silver again. I think gold and silver, which we've been on, and we've been bullish on, particularly gold and GLD. We've been bullish on that for a few months now. And I think now's the time to start to scale out and to wait for a pullback and a new consolidation before we try to maybe scale back in. And I think oil names are starting to pick up some steam. We've gone over oil names in detail, pretty great detail, over the last 2 Wednesday webinars. So if you want, you can always go back to my Patreon page and look at, or YouTube, and look at those, re-review the Wednesday webinars we had over the last couple of weeks. And look at some of those oil names to see if they've been performing a little bit better. All right, so now that we're done with that, let's take a look at the chart requests. Denise and Ray, you both have some questions. Ray, you have, I don't know if it's a question. UUP, you have a short printed on weekly and monthly. So to you, this looks like a short on the weekly and the monthly chart, right? I'm assuming what you mean by that is that whatever system you're using has called it a short. I think there's a potential for a short, but I'd be hesitant to say that this is a decisive short yet. Again, this is what the weekly looks like on UUP, and we did have, as of last week, that looked like a possible short, but we've got the move back today, or this week. I think it's early to just say that this is straight down. I mean, every trader has their own indicators, Ray. You have the 55 EMA for whatever reason on so you're expecting to move down to somewhere around here, and it's a possibility, but I think it's the way currencies work. I think it's a little early to just say it's a short. I find that it's much easier to analyze instead of analyzing UUP. I don't think UUP is that great of an instrument to really analyze from a technical perspective. We do use it, but a lot of times I look at this as just trying to figure out what the broad moves are, and honestly, it comes down to what I analyze out of the major crosses to me. Again, because I'm not going to trade the UUP. I'm going to trade either euro, the US dollar, or the yen or the Canadian crosses. And what I would say out of this is, if you take a look at what's going on here versus the euro, and I think this is the most important. This is by far the most important currency cross. This is a very key level. This area around 113, and ultimately, if the euro can hold here, then I would agree that then it looks like that we've got a good short on the US dollar and UUP. But if the euro fails here, which is starting to look like it's going to, then that's a bullish move for the US dollar, and that means it's going to run up on the UUP way past those levels that you were looking at. So I think this is the critical chart to look at if you're really concerned or interested in shorting the US dollar as a whole, is seeing what it does versus the euro. And I think that's really the key pattern to watch, more than what we're seeing on UUP. Okay? If you use US Canadian, then again, you need to look at oil and you need to look at that chart, because that's going to be very different from what we're seeing on these charts. Okay? I think that's something I want to point out for those of you that maybe are looking at trading currencies, is try to specialize in one or two. Don't try to trade a million of them. You should get used to why they move, what times they move, and if there's anything that in particular, like oil or something else, that would tend to influence one of these currency crosses more than the other. Okay? All right, so Denise, you had a question on CAG. All right, look like good support here. Is this a buy opportunity? All right, so this is the daily chart. That is a massive, massive drop. Well, let's take a look at some longer term levels and see where we, oh my. Okay, so this actually is a very good level, right? That's actually a pretty nice level. You can see we had, even when we look at it like this, right? We had a nice descent. We found some buyers at 18, came up to about 20. Then 20 kind of became an area here. You can see we had a double top, rolled right back over, came up and tested that 20 again, came down, tested 20, then broke out. And we never really came back and tested 20 from a selling perspective in quite a few years, right? The last time we really visited 20 was way back in 2012, 2013, right? So that's a very good support level. That being said, it's a major drop. Let's go ahead and analyze it from, say, the 30-minute chart. Yeah, I think this is okay, Denise. If you want to be aggressive, you could probably already buy it now, because you can see on the shorter term, we can scale back to maybe a 15-minute to give you an even more zoomed-in view of this. We'll get rid of this other trend line I drew. All right, so we had this, right? What we're going to do is, I'm going to color that one white. I'm going to give it some dots, right? So we came down. We found support at 20, which was expected. And then there was some resistance here around 2140, right? And ultimately, we broke out and failed, came out, broke out and failed, then tested that level and failed. And then we finally broke this short-term downtrend and have come up and, again, are testing this 2150. So ultimately, if we can move past this area, I think if we can get past 2140, 2150, we'll shoot way past 2180. I don't think 2180 is that significant. So it's a question of being able to hold here and break past this area. And if we do, I mean, yeah, there's still going to be a lot of resistance. You're not going to overcome. You're not going to overcome this kind of selling pressure in 2 days. But I would say this is a good support zone, and we have the makings of a bottom forming as we speak. Okay, so yeah, I would say that's a good buying opportunity. Now that being said, if the market could turn on a dime, and if it does, this thing is going to struggle as well. But I do think that's a really good long-term support, and I think that it might spend some time trying to hold there. But at the moment, it does look like it wants to move a little bit higher and start probing higher before it comes back and retest 20. So I would say for now, yeah, that actually does look like a good long opportunity. How much you can get out of it is still, I think, up for debate, depending on what's going to happen with the market. But I think that is a good pattern. I like what I'm seeing here. Again, if you look at the short-term trend lines, I think all of them are pointing towards an attempt at continuing to bounce here. So just watch it. If you're not really ready to get in yet, just watch it clear this area around 2140 to 2150. Once it does that, I think it would be a pretty quick move, probably up to about 22 and 2240. I don't know how much further past that, but at the very least, that's a potential partial scale out, and then you can just trail it up and see if you can get more out of it. All right, now the other one you're looking at is Square, right? SQ. So your question here is, enough of a bounce to consider buying here? Wonder if tax loss selling took it down, is now time to buy. There may have been, that might have been part of the issue at the end of the year with some tax loss selling just to try to get more book. I'm assuming a lot of traders already booked plenty of losses last year to begin with, but that happens a lot at the end of the year, right? So that could have been the case with a lot of equities. That being said, if we're just going to analyze from a technical perspective and not try to figure out the reasons for these losses or these drops, it comes down to us analyzing what we see on the chart, right? And I don't know that this one's ready to buy, not because I don't think it can bounce here, but because I don't see a pattern here that's worth giving us, well, that's giving us a good entry signal. So what we have here can be interpreted in one of two ways. It could be either a falling wedge, or if we want to just ignore some of the price points, we could say this is basically a descending channel, right? I think you can analyze it in either way, and I think it's fine in either way, right? You could say that's basically the channel it's in, or you could say that it's starting to form a wedge based off of the previous levels, right? And I think both are valid. I think I might go with the wedge for now. And the problem I have with this as a long trade or a short trade is it's right smack in the middle of it, right? Now, it's coming up into what was a pretty interesting zone, right? And you can see that price level around 50, 60 bucks basically was actually kind of important as we were starting to make our way back down. And right at the end of the year, that's one of the important price levels we lost, right? Even the first time we gapped below it, we immediately found buying to get back above that, right? So this is actually a really critical level around 59 that has sort of become important, and we're below it, right? So a lot like the markets, this is below a critical level. And really it's I mean, we've got more support down here. This is from the beginning of the year, around 45. So I think right now, this is not really where we want to trade it. And what I'm going to do here is, again, we're looking at, all right, so here is where we started last year, right? You can see this was an area of resistance, 45. We bumped up against it, and then we broke out. Ultimately, that served as a floor for the next rally to get back above 50, 57, 58, right? So if you look at Square, where it's at right now, it's in the middle of this zone. It's either a good buy at 45 or it's a good buy once it breaks 60. At the moment, it's not at either. So to me, I don't think this is at a spot where I'd be happy buying based off of the levels that I'm watching. Now, could it bounce from here? Could it break out of this wedge or this channel? Sure, but is the risk reward where I'd want it to be? Not really. If the markets do what I'm expecting, which is to bump up into the last year's range and then roll over, then Square is likely to roll over as it bumps into these two trend lines, this convergence between 59 and the top of this channel / wedge. And if that's the case, it'll probably roll over and come down to 44, 45. And at that point, it could be worth a buy even inside the channel or the wedge if it tests the bottom of it and we at least know we can get a bounce up to the top of the range. And that would be maybe something that would sort of coincide with that potential double bottom / capitulation pattern that we were looking at in the markets. And so maybe that's something that plays out over the next month or two. But for now, I don't think I'm ready to take this because, again, where it's at with respect to its ranges, it's hard for me to trust that it's ready to break past these levels. Okay? No problem. I'm glad I can help. All right. Well, that looks like it's it for today. We're at 1:30. I want to thank you guys for coming in, for participating, for listening, and hopefully we can start off 2019 on the right foot. Right? I know the markets aren't in the greatest of places right now, but if we can be careful and pay attention to what the market's doing, hopefully we can do fine. Okay? So once again, guys, have a good rest of today. Have a good, happy New Year, and we will meet again next Wednesday.